Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about why the stock market hates rising interest rates. Now, it's no secret at all that interest rates are going to continue to rise. The Federal Reserve has basically promised us that they're going to be doing that with several rate hikes this year. They have to do something because this is meant to tame the worst inflation we've seen in 40 years. And that's just the way they calculate it. It's probably almost twice as bad as they're saying it really is. Now, a lot of people are blaming this on the coronavirus pandemic. And in a way, I guess there's some truth to that in the sense that Trump just basically poured $2 trillion into the economy. But it isn't just all the coronavirus pandemic. That's what sort of triggered everything. What's gone on is massive money printing to the tune of about 11% compounded per year in an economy that's growing at maybe 2%. And that extra money that's being poured into the economy without a corresponding increase in actual productivity is absolutely inflationary and is going to really take some serious work on the federal government's part to get rid of it. We've currently held interest rates and the federal funds rate at zero for a long time. We've experienced interest rate hikes before. We have an idea what to expect. And what we know so far from all this time before is the stock market hates it when interest rates rise. Now, if they rise a little bit, in other words, if the 10-year T-bill goes from 1.6 to, I think it's at 2.8 right now, and it rises up to 3 or 4, I think into the threes is probably going to be okay. When it gets up into 4, 5, 6, 7, 8, then the stock market really hates rising interest rates. So if you're worried that rising rates are going to send the market at a tailspin, I would say you should probably pick up my market crash guide. We got it on a link right here in the description below. Help you get prepared for whichever way this thing goes. Okay, so go do that. And then let me tell you guys why the market hates rising interest rates so much. Obviously, Mr. Market isn't a real person, doesn't have real feelings, but what I'm talking about really is the way the whole market moves as a group and the effect this has on the whole market. When interest rates are rising, what happens is that the Federal Reserve is raising rates to promote or to cut back or to force a cutback on spending. The more spending that goes on, the hotter the economy gets, the more it's likely that inflation will continue to rise. And so by raising interest rates, those people who are on the margin and those businesses that are on the margin of just being able to borrow money at a 2% interest rate can no longer qualify to borrow it when the interest rates are at 3 or 4. As a result, there's less consumption. Less consumption means other businesses start to have to cut back. There's going to be some unemployment, and that is going to cause earnings to fall over the entire market. Now, as earnings start to fall, what happens is it's not just earnings are falling and the market goes down a little bit. When earnings start to fall, the growth rate of those earnings starts to change pretty rapidly, right? So let's say that the growth rate of earnings in the market is, let's say, 6% a year. Now earnings are dropping. They're not growing at 6% a year. They're declining, actually. And what happens with that is a giant reset of the price to earnings ratio in the stock market. You see the whole market start to reset, and it can become viral. So this market does not like those kinds of rapid changes in the monetary landscape. It doesn't like that because it starts to create a lot of fear, and that fear becomes viral. And we have so much of the market right now invested in passive stocks. Passive stocks are at least 50% of the stock market right now. That means ETFs, basically mutual funds that act like ETFs, are passively investing. They're not actively going out and trying to seek a good price. They're just buying whatever the index is that they're trying to track. So if it's a big mutual fund, they're tracking the Dow or the S&P. If it's an exchange-traded fund, they're tracking various indexes. If that index starts to go down because people are starting to withdraw their money from the market because they're afraid, then they're having to sell off. These exchange-traded funds have to sell in order to replicate the index that's dropping down, which creates more panic and more fear, and what starts gradually starts to accelerate. So this is a really big potential problem we've never seen before in history. We've never had this gigantic portion of the market be invested passively. And what we saw, of course, back in March of 2020 with the COVID meltdown was an incredible meltdown. I mean, the market dropped like a brick in a matter of a few days as these exchange-traded funds had to sell off. Now, if we see that again, you guys, the bad news is the market's going to crater. I'm talking down 50% or more. And the good news is that that becomes an incredible buying opportunity if you know what it is you want to own. If you've created a list of really wonderful businesses that are anti-fragile, that means they're going to benefit from the chaos and from the meltdown in the economy. They're going to benefit from that, and they're going to grow while that's going on. Those kind of businesses, grab my market crash guide. You guys, it'll be an idea how to get started on this. And that's where we want to end up. We want to end up with a handful of wonderful businesses that are going to do fabulous in basically any kind of market. And we want to buy them on sale. So now I'd love to hear from you guys. How do you think the market's going to respond to rising interest rates? You think I'm right? Think it's going to crater eventually? Leave a comment below with your answer. I'll follow up with you. And thanks for watching. Now go play. If you enjoyed this video and you think it was valuable for teaching you more about the relationship between the stock market and interest rates, hit the like button and, share the video with your friends. If you want more investing content, subscribe to my channel. And don't forget, click the button on the screen. We got a free gift. And thanks again for watching.